Hey guys, how's it going? Welcome to the channel. In this video, we're going to describe the option wheel and the wheel strategy. You guys might have heard it in some other channels, but today I'm going to describe it and how I do it and how I make it better, in my opinion. It's been working out pretty good for me in the last 6 months to a year. I've been making 1% a week, and I've never been called or put it on. I've never been put it on my stocks. I have been called because I want to be called if I want to get a dividend. So I'll teach you how I do the wheel strategy and how I make it different from everybody else. So for my wheel strategy, pretty much I have a majority of my portfolio wheeling every week, making 1% a week, at least minimum 1% or more. So I like to choose fundamentally strong stocks that are very weak in comparison to the rest of the market. So they have a lower downside potential. They're weak for a reason, right? But we use a little bit of technical analysis and a lot of fundamental analysis to make sure we're not writing puts on weak stocks. That's how the wheel strategy works. First, you have to write puts on stocks. I'll give you an example. Today, we sold puts on Pfizer. Sold puts at around 36 cents on Pfizer when it was near $29. That's 29 strike for the week. And you say, how do you know it's not going to go under $29? We have our ways. So the stock is trading at $29, but there was a lot of open interest at the $30 mark, and we're looking at the macro flows, the option flows in the total market, and it was staying strong. So we know it's not going to breach with a high certainty. So depending on the stock, there's a certain amount of open contracts on that stock that can affect that price. It's called option pinning, and you can look it up on Google. Max Payne theory of options. There's many academic papers written on it, research papers, but what they don't describe, what some of them say there's no correlation to this and that, but there is correlation. It depends on which stocks you choose. If it's a big stock like Tesla, where open interest changes every week and it moves very volatile, there's a little bit less correlation. It can slide 20, $10, $15 on a move. But those are the stocks where we write puts on. For the majority, we like to write puts on. The majority of the time, we like to write puts on cash flowing, strong generating stocks. For Pfizer, for instance, they're a slightly declining company. They're running out of COVID revenues. They're near COVID low in terms of share price. So this is a good point, and fundamentally speaking, to own the stock. So it was at $29. We wrote this contract at 36. That means I would own the stock at 28.64. If you own the stock at 28.64, it's almost a COVID low of $27. I don't see how you can beat that price if you get putted the stock. But we know we're not going to get putted because there's abnormally amount of open interest at the $30 strike. At the $30 strike, there's a fair amount of open interest in comparison to other strikes and other days and other weeks. So we know a lot of market makers rub puts on that strike for that certain day. So or somebody else bought those puts, or somebody else bought those puts at that price, and we know in this specific instance that the market maker is going to push the stock price up to 30. What did Pfizer close the week at? $30. Now this doesn't happen with every stock. It only happens with specific stocks, which is abnormal open interest. And you're not going to know this unless you watch the stock market every day. You're not going to know which stocks have abnormal interest and which don't. And so how the strategy works is, I actually wrote puts on Pfizer twice. I bought back my puts at like a little bit under 10 cents for the week when it pumped up, watching the market flows, the macro SPY SPX market option flows, and then sold it again when it dipped back down. Sold it later on Thursday for 16 cents. Crazy, right? You can get 0.5% in one day. That's a pretty big move. So, as you're saying, so if you do get called, the other part of the wheel strategy is is called the covered call strategy. So the next week, if I did get called, I would write an option at 29 for 30 cents, at 39 cents. I wouldn't at 30 cents. I wouldn't mind only selling another covered call on P Pfizer. That means if the stock goes, I would write the covered call at 29. If it goes under 29, and make around 30 cents. I'd make another 1% for the week. If it goes a little bit lower, just keep adding down and averaging down with that premium into your stock price. So now, you already have the stock at a low and it has a strong pipeline and strong growth prospects. The drug pipeline is very good. And every week we do this with multiple stocks, different stocks, and that we'd love to own. Take advantage of theta decay. So, occasionally we do this on master or MSTR stocks with strong volatility, but we can kind of gauge where the price is going to be. We use options markets on Bitcoin, different kinds, just to see where the big money is headed. Wants the stock or the Bitcoin price to be. This week, for next week I have 2% premium on Bitcoin, and I'm looking to cash that out at some point early on in the week for about 1% premium, about half the 2%. So, and there's other plays that we also do in the group, in the Discord plays. Next week I'm planning on taking a straddle on Nvidia, AMD, and Intel before Nvidia earnings. I believe there's going to be a volatile move in the market. I don't want to be in any stocks before that move, but that's going to be one of my plays next week. We do different kinds of plays. I have a free Discord group. If you guys want to join, the link's down below. So that's pretty much how the strategy works. We keep track of the open interest, the fundamentals, the technical analysis, and the options flow. The options flow is big because that way we can kind of gauge where the market is going. If the market's having a red day, maybe hold off a little bit before write the put on the option, on that stock price. And sometimes we take, but with a small percentage of a portfolio, sometimes we take lateral plays. Occasionally we see large asks coming in for some stocks, smaller stocks. We take those lotto plays. Just if it's worth it. If we think we can make 50% off a small amount of money, maybe if your portfolio is 100,000, maybe throw in $500. Make 2-3x. Get a few contracts. If you have $1 million portfolio, maybe $1,000. Get 10 contracts. 2,000, and try to make 20 to 70% on those. But only if it's unusual option activity, like a smallish type stock gets 100 to $2 million worth of option volume at the ask. We know that's unusual. How do you guys know unusual? It's unusual. You don't, unless you follow the data, religiously. But that's what we're here for. We have a free community. It's only free for a limited amount of time because it's tough to maintain these free communities, because once you start writing a lot of options on stocks, buying a lot of options, it changes the outcome, because the market maker on the other side has to take those options. So even though it's safe, it's not safe forever. So because the stock market is a zero-sum game. If you are winning, somebody else is losing. That's the way it works. Anyway, and if you guys have any questions, comments, anything you guys want to ask about the strategy, let me know down below. Sometimes we do the inverse of the strategy. If there's a lot of open interest on specific stocks, close to expiration, we might, close to expiration or on expiration date, we might play the inverse. It depends on the stock. Again, not every stock will follow the Max theory of pain, Max Pain theory of options. You can Google that if you want and learn more about it. So, and sometimes we do credit spreads, but it really, it depends on what your preference is. there's somebody in our group that does credit spreads. It says he's 96% win rate. And I personally, I don't like credit spreads because you kind of get addicted to them, and that one loss can set you back for you have to be actively managing that credit spread every day. But I'm learning more about them credit spreads as well. I might do on some stocks that I know are not gonna. If all the stars align, then I'll do a credit spread. I don't like to risk my money that way. But I'm still learning, so learning more advanced option strategies, and I might be prone to take some in the future. There's definitely a lot of professionals in our group: Wall Street traders, robot engineers, software engineers that do credit spreads. Professional traders that do them on a daily. If you guys want to join, I'll leave the link in the description below. Thanks a lot. Please like, follow, and subscribe. Let me know what videos you guys want for the next video. Thank you very much.